Hey, everybody. Welcome. Thank you very much for joining. My name is Matthew. Today, I'm going to answer the question, since 2008, has the Federal Reserve had a corridor policy rate system or a floor system? Okay, so here we are again, 108, almost 109 years of the Federal Reserve's balance sheet. Full picture from the discount rate to the Fed funds being tracked here in the 50s to a Fed funds target rate, which eventually turned into an upper and lower bound after the 2008 financial crisis, to also paying interest on reserves, which I covered in yesterday's video. I will do more of that today. But there's one more interest rate that I have not talked about yet. I'm going to do that right now. So our story for today starts about here. We are post.com bust, post 9/11 crisis. Alan Greenspan, later dubbed the Maestro by the New York Times, takes interest rates to historical lows. And the discount rate, as always, as I've talked about, except for the 50s and the 60s, at least from the data that I'm looking at right now. And remember, in the teens and the 20s, before the Great Depression, the discount rate just worked like any other bank rate, except for the fact that the Federal Reserve could print money ex nihilo and lend to banks at that discount rate. The discount rate never, other than the 50s and the 60s, never followed Walter Bagehot's advice. See my prior video in this series on that. You see that the discount rate is under the Fed funds rate. The discount rate should be above. It should be penalty interest in times of crisis to good collateral banks. Okay, so the Fed has lost control of this idea. That's not what they're doing. So they changed this in 2003. They changed it. And they say, we're actually going to have not just one discount rate, we're going to have three. All right. The first one is going to go back to our Walter Bagehot type of a rate. And they actually said this. They applauded themselves for getting back to Walter Bagehot here. First one is going to be called the discount window on primary credit. Only for good banks, only for big banks, only for city banks, as they used to be called in the US, the discount window on primary credit. So let's see what happens when they discontinued the discount rate and they start the discount window on primary credit. How does it look? There we go. It's back above the Fed funds rate. It's back above the rate, both that they target and the effective rate that banks lend reserves to each other. It's back above it. All right, so this is a good thing, according to them, that they're finally adhering to Walter Bagehot. Again, I'm sure Walter Bagehot would be turning over in his grave just seeing how much they've butchered his theory over the last 100 years, but nonetheless. Now they have it. Now they have a discount rate at penalty interest for banks with good credit. The other two rates they don't really publish. What are the other two rates? Remember I said they split it into three. There's the discount window on secondary credit, all right, which are more like regional banks, country banks, smaller banks, credit unions. The United States has a big history of smaller banks, really more than any other nation, in fact. And this is probably a fact of bad regulation, which we can talk about in another video. Banks couldn't branch across state lines in the 1700s or the 1800s. The only banks that could do that were the central banks of the United States' history. So, of course, they've made the claim that really the reason this discount rate before was always under was because it was smaller banks, seasonal credit type of instruments that, we just needed to have that lower. I presume it is lower than the federal funds, at least as far as I've seen. I haven't seen a full, transparent secondary credit or seasonal credit window published by the Federal Reserve. Nonetheless, they applaud themselves, literally, in a paper and many papers, for getting above the Fed funds rate here with this new discount window on primary credit. Now we get to the financial crisis. So they applaud themselves for a couple of years. Greenspan has to raise rates because inflation is running hot from the all-time lows that he set right here with the Fed funds rate and the discount rate. Post 9/11, post.com bust. We know the story. We've talked about it many, many times. But there's also, about this time, right about when he hands over the reins to Ben Bernanke, some regulation is passed for the Federal Reserve to do one more thing with reserve balances. And mind you, reserve balances are extremely small at this point. You see that in the tooltip, 6, 7, sometimes they pop up to $20 billion, $10 billion. Not at all comparable to the amount of notes, greenbacks, that are in circulation, which is mostly reflected in that lighter green. You can see the reserves there by that green bank icon, very, very small amount on the left axis until the financial crisis. So what is this regulation? Well, it says that, okay, we recognize in the United States we have a lot of reserve requirements, primarily for larger banks, primary credit banks, systemically important banks, as they come to be known as. We have a lot of reserve requirements, not so much for secondary banks, but we do for bigger banks. And since we also have foreign banks that bank in the United States and can hold reserves, but they don't have any reserve requirements according to their home banks back home outside of the United States, we are going to pay some interest on reserves to large American banks that might need it, if they need it. Has nothing to do with monetary policy at this point. It's just meant to be a buffer. The Fed is always looking out for its banks. It's owned by the banks. This is not a surprise. The idea is not a surprise that they would try to do something to help the banks. And apparently foreign banks are kind of getting off easy here because they don't have reserve requirements in their own country. They also don't have to pay FDIC insurance in the United States because their operations aren't retail in the United States, a lot of them. So this idea is that basically to help out American banks who have to deal with more onerous regulations than foreign banks, we're going to start to pay interest on reserves, or we will pass legislation that will allow this. Now, they never enact this until the crisis. So the crisis occurs, the interest rates drop rapidly here in 2007, start of 2008. No one really knew we were in a recession until very close to the end of 2008. As we know, many, many things happen here in the timeline. I'll zoom in as I've done before in just a second. But we see here that Bernanke is now being as accommodative as he promised he always would. Lower interest rate in the realization that banks are having a lot of bad mortgage-backed securities and bad loans on their books. So I'm going to move into crisis mode here. And let's see what happens when the Federal Reserve actually does start paying interest on reserves once more. Let's zoom in all the way till the end of 2008. This timeline will look easier to read again. Here we go. Okay, we've talked about this. See prior videos for more. I've decided to put the interest on reserve rates now in a dotted line, so it's a little bit easier to see because there's so many different rates, as we see here. So we have the black dotted line now. That's the discount window on primary credit. Okay, that's above the Fed funds target. And again, it says lower at this point just because I've combined it once they start a range here in December. Once they take rates to 0, the lower range is 0, the upper range is 0.25 of the Fed funds target. So I figured it's actually easier to look at this in a dotted line. So the two dotted lines below the discount rate and below the Fed funds target at this moment are interest on reserves. The upper one is interest on required reserves. The lower one is interest on excess reserves. So they start this policy tool, which was approved in 2006 for banks. Now, if the Federal Reserve was running a corridor system where interest on reserves, or actually more specifically interest on excess reserves, was the lowest rate that they would offer, and that's the idea of a corridor system, that would be reflected here. Okay, you see this? My mouse is right on it. It's the auburn shaded dotted line here, 0.75%. We have the Fed funds effective rate, which banks at this very moment in crisis mode are lending to each other, 1.04%. This is the week of October 15th, Wednesday. The interest on required reserves is more. He knows that he's printing a lot of reserves at the moment to bail out banks. He doesn't want them to immediately lend out at least the required reserves, so he sets that higher. The Fed funds target is still higher yet, and the discount window remains a little bit higher yet for penalty interest if a bank really, really needs it at 1.75%. Now, what's the point of the corridor? Well, the corridor is, we're going to be more scientific. We're going to have many more interest rates now. This bottom level of the corridor will be interest on excess reserves. The Fed funds and Interest on required reserves as well should be around there, because required reserves is what banks should always hold, because again, there is no reserve ratio that's required for a lot of smaller banks in the United States as well. But the larger banks, this number that's typically used is 10%. So that means that reserves should at least be 10% in value of your total demand deposits outstanding. So the interest on required reserves, the Fed funds rate, the target rate, the effective rate should all be in sort of the middle of the corridor. And then the discount rate, which we talked about at the beginning of this video, the discount window on primary credit, that is the roof of the corridor. Okay? So it looks like a corridor for now. Okay? Discount window at the top, Fed funds stuff and required reserve interest in the middle. Okay? And then the interest on excess reserves at the bottom of the corridor. Now, it doesn't take too long to see what happens. How long did this corridor system actually stay in place? 1 week? 2 weeks? Let's look at the second week now, the second Wednesday. Interest on excess reserves still 0.75%. Fed funds is just above it, 0.81%. The target is well above that, as we talked about in prior videos. They're already losing control here of their target, 1.5%. Interest on required, same, 1.4%. And the discount window is 1.75%. So even though the Fed funds effective rate, the rate that banks are lending for each other, is starting to crash, they're starting to tell the Federal Reserve, we're not going to take much risk here. The corridor is still in place, right? But after 2 weeks, the corridor has now been floored. And I use this term floored from Dr. George Selgin. He's written a book on this. I recommend it. It's called Floored. Talking about this system, why it started, the Federal Reserve's original intent, what they say they want to do and what they actually do. Again, I'm just trying to keep it relatively simple here. Let's just look at what they're actually doing. The Fed funds rate, which is supposed to be in the middle, as well as the target rate, of course, is supposed to be in the middle of this corridor. It's now below. It's below the interest on reserves. And it takes only, 3 more weeks, for a total of basically 5 weeks, for the interest on excess reserves and the interest on required reserves to converge. And they converge at the Fed funds rate at 1%. Okay, so now it doesn't really matter at all if you have some reserves that, okay, the idea is that, and maybe I don't say this enough, the idea with all of this, and I'm not defending the Federal Reserve here, I'm not defending central banking here, it should be understood. The idea with all of this stuff is reserves are scarce. The Federal Reserve, yes, it is a lender of last resort, but reserves are meant to be scarce-based money, and you need to lend that out to help the economy. That's the business that banks engage in. So banks should lend out reserves. They should engage in lending. And regardless of what the reserve ratio is, the interest rate that they pay each other, that should be relatively targeted by the Federal Reserve, close to the red line. We see that it's not at this point. And it should reflect sort of the most risk-free type of a rate, because when banks make loans to each other by the way of reserves, some banks are short on reserves, some banks have reserve surpluses. They lend to each other. That's reflected in this interest rate. These are uncollateralized loans. There's no need to collateralize with securities or anything. Everybody holds the reserves at the Fed. They know that the reserves are at the Fed, at the central bank. So these are uncollateralized loans. And these should be the safest sort of a rate anyway. And then they continue on and they make loans with rates that are much higher, and they collect a spread. But this whole business of interest on reserves, it begins, again, in 2006, as I mentioned, with having nothing to do with the crisis. Just having to do with giving banks a little bit extra cushion compared to foreign banks. But now it becomes, as I talked about yesterday, it becomes a policy tool. It becomes something that Helicopter Ben Bernanke wants to use to control the amount of reserves that banks lend out. And rather than have it be a pure corridor system where, just some interest on excess reserves is at the bottom, all the Fed funds, the target, the effective is in the middle, and then the discount window is on top for penalty interest if you need to come directly to the Federal Reserve for a loan, all right, as Walter Bagehot said, rather than having this corridor system, which they had here for literally 2 weeks, they moved to what Dr. Selgin has termed a floor system, where now we have the Fed funds, interest on reserves, both required and excess reserves. There's factually no difference now. Fundamentally, there's no difference between required reserves and excess reserves. Again, what is the difference? Required would just be reserves needed to hold that reserve ratio for your deposits, and excess would be, well, okay, you need to lend those out. You need to take more risk. You need to help members of the economy, and this is the idea of central banking. But that's not what happened. That's just not what happened. As we move on here, we see that, okay, the Madoff Ponzi really spurred the Fed to drop rates to zero. The Fed tries to be cheeky again and has a lower bound and upper bound of Fed funds now. So the lower bound, as you see, I've always labeled it the lower here before this date of December 10th. The lower bound is now 0. The upper bound is 0.25%. So that's in blue now. I'll take out let me take out all of those rates so you can just see it. There it is in blue, the upper bound. Okay. Lower bound is at 0, which I'm using as the prior entire target, which was never a range. Discount rate is still above. Okay. And the Fed funds, again, this is okay for now. It should be in the middle of this corridor. But where is the interest on both required reserves and excess reserves? Let's put them on. 1, required reserves. 2, excess reserves. They're the same level, and it's the same rate as the Fed funds upper target of 0.25%. And so it actually becomes what Dr. Selgin has termed a leaky floor, or a floor with a subfloor, because you see that the Fed funds itself, yes, they're doing a good job of keeping it within that little range. All right, the Fed funds now is 0.1%, 0.12%. It's between the lower target and the upper target for the Fed funds rate. Again, these are the rates that banks are lending to each other. But why would banks engage any more in the economy if for their entire level of reserves, they can just park them at the Fed and get 0.25%, which is the exact same level as the Fed funds target upper rate. And it's the exact same level, as I just said, of the interest on required reserves and interest on excess reserves. So why would they want to take any more risk, especially in such a risky time? And indeed, they don't. We can zoom out here and continue on. This is the world of zero interest rate policy, ZIRP level interest rates, where basically, for over 5 years, the interest on required reserves equaled the interest on excess reserves. So there's fundamentally no difference. Only for 5 weeks there was a difference, and only for 2 weeks there was a corridor. So there's fundamentally no difference. It's not a corridor system. It's a floor system with a leaky floor where the actual Fed funds effective rate that banks lend to each other is below that. So it hardly shows that they're doing a good job of sort of targeting where they want the rate to be. And it's a floor system. It's a leaky floor system. It's not at all a corridor system. Again, this dotted line, really the interest on excess reserves, but both of them are the same. The interest on excess reserves should be below any Fed funds target rate and any Fed funds effective rate. So the Fed funds effective rate, you can see, that's not the case. It's below that. All right, it's in the leaky floor, the leaky basement. And I'll even take off the lower rate because it's kind of meaningless as I go up here. So let's just look a little bit. I don't want to go too much into what happened here with COVID and whatnot. But let me take off the lower bound just so you can really see how much of a floor system this is. Okay, so as we go up, let me zoom in. As we go up here, they're trying to normalize their balance sheet. But they're not doing it in a way that they typically would. In a typical way, how banking would go, you would just allow banks to lend out reserves because there'd be no interest paid on reserves, and the economy would equilibrate with any new reserves. This is an important point, by the way. It's not just the fact that the economy is uncertain during this time, or the Fed is so accommodative, that they're not lending out these reserves. It's precisely because of the interest rate. Dr. Selgin has made this point, as I understand, to many Fed economists who say, well, it's just, banks aren't lending out reserves because things are so uncertain. In Weimar, in Weimar Germany with the Weimar hyperinflation, banks found plenty of ways. They had reserves that were printed even faster than this. All right, not just paper money, reserves, ledger-based money that was printed even faster than this. And they found a way to lend it out. So banks can always lend out. This is just the nature of banking. That's what they do. They lend to try to find the best use of that capital, and they keep a spread on the interest. That's just how it works. That's how capital markets work. That was not possible here. It was not possible for them to lend because, one, Bernanke just didn't want to let all of this monetary inflation fly into the economy, as we talked about, because that would be highly price inflationary. But two, he just figured, let's have this interest on reserves and let them park it here in order to stop that. And that's exactly what happened. So banks aren't even really worried about parting with their own reserves on the short-term basis. You see the Fed funds rate is below the floor, the subfloor. Basically, it's below the interest on excess reserves, which is the same rate, again, as interest on required reserves and the Fed funds rate. It's below it all the way up here. So the only way that Bernanke can get banks to lend some money is to shrink the balance sheet, which he tries to do here. He tries to normalize. Really, from 2014, he stopped printing. He stopped QE3 from mid-2014. And then the only way really is to raise the policy rate. But that's not how banking typically works. I don't raise the rate to get you to lend more. That's just not that's not typically how it works. I either print more or less reserves, and then the economy would equilibrate anyway because you have a reserve ratio. But this is what he has to do. So he has to shrink the balance sheet, and he tries. But then we get to here, the repo spike. We'll talk more about this in future videos. And then here, of course, COVID. Everything just goes to hell anyway. And by the way, I'm sorry, I know I kept saying Bernanke the whole time. In this window, actually, this Zoom, Yellen took over somewhere here, 2014. So she was actually the one that had to do the hard work of raising the rates. And then Powell took over during the Trump administration in 2018, and he continued the hike. But the idea, of course, Ben Bernanke is credited with a lot of this because interest on reserves started under his watch, or at least the start of his watch, the end of Greenspan's watch. And then, of course, just the massive monetary inflation of the balance sheet, reserve balances. And then, of course, just using this policy that was passed in 2006 to now affect monetary policy, which was much different than what it was originally intended for. Unintended consequences can indeed occur. So this was the only time where it was anything like a corridor system right here. The first 2 weeks of trying it, October 15th, October 22nd, the moment that the Fed funds dipped below it, there was really no going back. Why would banks even take any risk lending their own reserves out to other banks, which is what the yellow thing is, the yellow line, when they can just park their reserves, not do anything at the Fed and receive interest? And that's exactly what happened. So it's not normal banking. It does, though, again, to be clear, what that does do is it stops this big green mammoth whale of a money supply, which has exploded, right? Remember, it's only $10-20 billion before the global financial crisis. All right, so all of these bad assets, bad mortgage-backed securities that were taken off of banks' books and some even indirectly money market funds books, QE1, QE2, QE3. The reason that all of that never made its way into the economy was because of this stated corridor system, but really it was a floor system. And it's because banks got better interest on their reserves with the Federal Reserve than they could get anywhere else. And I'm going to show you this even further now. In the next video, I'm going to compare this interest on required reserves and interest on excess reserves with other rates in the market. Thanks for watching.